Executives from Silicon Valley Bank and Signature Bank are testifying right now about the failures of their institutions in front of the Senate Banking Committee. The banking turmoil began in early March and has since dominated headlines. On March 8th, crypto-friendly bank Silvergate wound down operations after taking dramatic losses following the collapse of FTX. On the same day, Silicon Valley Bank revealed a massive loss from withdrawals and plans to raise over $2 billion in capital to make up for it. The next day, there was a $42 billion bank run. And on March 10th, shares were halted and regulators took control of the bank. 2 days later, the feds took control of another bank in crisis, Signature Bank. Biden tried to reassure Americans, saying that the banking system is safe. But days later, Switzerland's Credit Suisse also started to crack, with shares hitting new lows. First Republic was also suffering, and on March 16th, 11 big banks rescued it with a $30 billion deposit structure. Now, in the meantime, SVB that filed for bankruptcy and UBS acquired Credit Suisse. Regulators then announced First Citizens Bank would acquire the bulk of SVB's assets. But more trouble was brewing for First Republic, and the bank released a statement saying it was, quote, pursuing strategic options. About a week later, regulators seized First Republic, and the bank was sold to JPMorgan Chase. In the last couple of weeks, the fallout from the crisis has stayed with us. Shares of PacWest dropped on May 4th on reports of a sale, and shares stayed in the red on news that the bank lost nearly 10% of total deposits. Today, regionals, they're mixed right now. However, as this hearing goes on, it'll be interesting to see where that tick-by-tick action continues to move, Julie.
Yeah, and especially since the focus now has turned towards regulation, maybe the banks will actually get a little break. We'll see what ends up happening. But the hearing is underway for those bank executives, also for regulators. To help break down the implications of the crisis, we're joined by John Heltman, American banker, Washington bureau chief. John, good to see you again. Obviously, it's a pertinent day to be discussing all of this. And I guess to sort of pick up on my last point here, it is some of the executives who are testifying today. There's also another hearing that is talking to the regulators. Those two tracks, what do you think we need to be paying attention to? Which is more important right now?
Well, how's this for an answer? They're both equally important, so watch both.
Good answer.
One with each eye on two separate screens. There is a common thread through both of these hearings, and that is that since the outset of this crisis, at the very beginning, Democrats and Republicans were kind of trying to figure out what they thought about all of this. And that has since, I think, somewhat solidified into two kind of counter narratives. On the Democratic side, the point here, what you are seeing here with this series of bank failures, is a failure of regulation, a failure of, an inability of regulators to adequately regulate because of some of the policies put in place during the Trump administration. And that's their line. Republicans, by contrast, have sort of solidified around this idea that it is the regulators themselves that are institutionally unable to regulate banks. And so it's the regulators' fault. And new regulations or overhauling the regulations to make them more stringent on mid-sized banks would not be helpful, would not have prevented this crisis. And I suspect that in both of these hearings today, you're going to be hearing basically like reiterations of those dual tracks.
Has the flight of deposits stabilized from your perspective?
Well, the regulators certainly seem to think so. Janet Yellen had comments out this morning at a speech saying that the contagion risk is contained, that deposits have stabilized. Regulators in their prepared testimony for the hearing this morning saying similar things. Now, they also are saying that there's some risks out there in commercial real estate, potential credit risks, credit write-downs there that could affect regional banks and smaller banks. But yeah, so there's the deposit flight seems to be over. It seems like there aren't any other SVBs out there that have enormous reliance on business accounts to make up their deposit base. You have those that rely more on those are seen as more risky. You mentioned PacWest. That's kind of the next one in line. Western Alliance, similarly. So we may see still more failures, but those banks aren't really on the order of size that SVB or even Signature was.
I mean, as we talk about the so-called idiosyncratic features of the various banks that failed, right? Whether it was in crypto, whether it was in relying on startups, or sort of the balance of business, that hasn't been something historically that has been regulated at all, right? In other words, the type of businesses that a bank caters to. And it doesn't seem like that's something that the regulators would consider. Is it? So how do you sort of address those risks without directly addressing those very sort of specific things at those banks?
So the bank regulators, especially the Fed, but really all the bank regulators they have regulation and they have supervision, right? So regulation is pursuant to a law, and it will say as part of so for example, in the Federal Reserve's guiding light is the safety and soundness of the banking institutions they regulate. They can pursue or push a regulation saying you can't do this or you have to do that, and that applies to all banks equally. They also have something called supervision, where there is somebody looking over a banker's shoulder and saying, "Are you sure you want to do that? Is that a good idea?" And if they do it anyway, they can issue something called a matter requiring attention or a matter requiring immediate attention, which then goes to the board and sort of forces a decision. Now, some of the concern, again, from the Democratic kind of line of argument here, is that in the prior administration, there's this emphasis on not using supervisory actions to sort of act as de facto regulation, right? And that's something that I think Democrats are going to try to push back on. But to answer your question, there's lots of things that bank supervisors can do to tell a bank, don't do this or do more of that. For example, if your deposit concentration is way too high in one particular sector, that might be something that they would get dinged for. A bank would get dinged for now that they wouldn't have before.
There's typically more theater politically here on events like this than there is on 42nd and Broadway, especially on these occasions. So how can regulators signal not just to banks that they've got a firm understanding about what they need to do, but also to the broader public that they're acting in the best manner for the broader system at whole?
Well, they can just say those exact words and let lawmakers kind of question them. That's part of the point of this exercise of bringing the regulators out, bringing the banks out, or the bankers out to kind of call to account for their actions. Now, the regulators have been up to the Hill a few times, and they're going to be up again. So the regulators are in the House today, bankers are in the Senate. Tomorrow it's bankers in the House, and then Thursday it's regulators in the Senate. So everyone's going to get a taste. And I think at this point, especially the FDIC put out its proposal for how to replenish the deposit insurance fund last week, which placed most of the onus on the biggest banks to repay that loss that was incurred during the failure of Silvergate and Signature. It invoked something called the systemic risk exception, which means that they would insure uninsured deposits at a loss to the deposit insurance fund, or the DIF. And then they're also then required to do a special assessment to refill, to sort of replenish those losses. And during the board meeting, the FDIC board meeting last week, during that proposal, Republican board member Jonathan McKernan sort of took exception to the idea that the biggest banks would be paying for this. I would be interested in seeing if any Republicans sort of follow that line of argument during either the hearings today or later this week.
John, we're going to continue to keep a live look on this up for some of our viewers as much as we can. But we got to wrap things here for today. John Heltman, who's the American Banker Washington Bureau Chief. John, always a pleasure getting some of your insights and coverage around this too. Thanks so much.
Thank you.